we know of the challenges of managing projects, issues that we also talked about in our previous updates and we've been talking about all the time. At the end of the day, the fiscal deficit has increased, or has been around 6%, and will slightly be lower than what had been expected. But overall, this is still high, especially when you are considering that the private sector needs to exist in this economy and take space in terms of contributing to growth. The good thing this time round is that up to 88% of the deficit was funded by external resources, as government tried to ensure that it reduces the crowding out of the financial sector. In the outlook, you will note that when you look at the analysis or the assessment that we've done, that we have what we call new shocks that actually still old shocks. We know them, we've been talking about them, the financial system, the Southern Sudan, maybe the global economy. Maybe the new one is the expected, or we don't know what the impact of the avian flu can be, but you can anticipate that tourism and maybe production and export of things like poultry may be affected. Thank God the government has announced that this has confirmed that this may not go to the human, but in terms of these producers, you'll find that there might be an impact. And if the Southern Sudan question is not yet resolved, it is hard to expect that economic relations between Uganda and Sudan will go back to normal. We've been seeing a decline in exports. We've been seeing a decline in exports since 2015, but this became worse in July when there was an outbreak of a crisis, and exports reduced to about 7 million compared to what had been recorded in the previous months of about 25 million every month. And there are several other issues that affect the outlook on this front. The banking system, you've heard about the developments, the closure or resolution of one of the biggest banks, and much as that has been resolved, we can expect that maybe there will be some time in terms of catching up back to the level of operation that existed before these developments came on board. And the quality of loans is yet to improve in the banking system, so that will also take time to resolve as we go on. The policy response. As we've heard before, monetary policy easing may be challenged. It can continue, that is the right response to go ahead with, but it may be challenged as inflation increases, as the drought hits. We've heard about food shortages, we've seen the depreciation of the currency, and all these are going to complicate monetary policy management, or the effort to ease, to increase liquidity in the system. Fiscal policy is expected to remain an instrument that will try to rejuvenate the economy, but financing has to be done very carefully so that it doesn't crowd out the private sector. The external sector will continue to be a source of distress, and therefore, we expect that GDP will grow in the range of 4 to 5%, which is not very different from the previous year when GDP was recorded at 4.8%. We expect that there will be, as these issues are sorted out, there will be a gradual acceleration to about 5.2 in the next financial year, and probably 6 in the medium term. But There are risks, and many of them relate to how the fiscal authorities are going to manage to complete the key projects, because that is the key instrument now to stimulating economic activity, but also to how to finance in order not to crowd out the private sector. Risks remain about the regional markets, as I've mentioned, South Sudan, but also DRC and the coming elections in Kenya. And debt right now is sustainable, but growth must happen. The exchange rate must remain stable, and exports and revenues must be realized out of the investments that the country is making for debt to continue to be realized. And then lastly is the climate issue. But as we move forward, we also have to reflect back and think. These growth rates of 4-5%, this is not a story for Uganda, really. We are still a very poor country, and we should be growing above 10%. About 4.5, and the country was able to make 7-8% in the past. But with a population growth at 4.5%, it means that per capita income is growing at 1.5%. To reach middle income status, Uganda's per capita income must be growing at 9% if the target of 2020 should be realized. And to put it clearly, the GDP growth that we normally focus on, the 4 to 5%, must be growing about 12%. Because 2020 is not very far. And that is the target we've set for ourselves. So let's put our instruments together and make sure that growth is happening. Lower growth rates are not only about also achieving middle income status, but also have implications for poverty. You've had the issue of shared prosperity. That is about reducing poverty for everyone, everywhere. In the past, when growth was growing, when we had very fast growth, per capita poverty was reducing at about 1.6 percentage points per year. Reduce growth by half, then poverty is expected to be reducing by the same level. And Uganda is being left out by neighbors and peers because, as you realize, Uganda's rate of growth is much lower than that of Kenya, that of Tanzania, that of other regions in the sub-Saharan, almost the same as sub-Saharan Africa. But we don't want to compare Uganda to dwarfs. Then what can accelerate growth? Among the things that I've said, I haven't touched what has been happening to investments. When growth was there in the 90s and early 2000s, investments were actually accelerating. Private investments moved from about 8% to 11% per year. The opposite has happened in recent years when you have low growth. The recent increase in public investments that we keep saying is going to be the stimulus is a very important issue. But that is a transitory factor because you can't be investing in the public can't be the only one investing. The private sector has to eventually pick up the mantle because the public sector is just creating the environment for investment. But beyond infrastructure, we think that private investments require capital, and hence the need to look again. We've been looking at the financial sector, but from this angle, how do you make sure that the financial sector provides the needed capital for investments to take off? By the way, also resilience to shocks that we've been talking about and the risks will also be constrained if we have a very strong financial system. I'll quickly go through some of the highlights of the financial system. For example, we know we are very clear on who in Uganda is offering these financial services. If you know you want to make a saving, you probably run to a bank, a credit institution, or any of those other many, maybe SACCO or National Security Fund or even insurance. These days, it is being sold as a savings vehicle, which is the right thing to do anyway, because you put in money. At the end of the day, if something happens, you can get it out. If you want credit, the same institutions. You want payments, you can go to any of these institutions, but a new element that has come on board is the mobile money, which has actually become a very important mode of making transactions. Which has become a very important mode of making transactions. And as you've heard from the remarks from the country manager, is making headways in terms of increasing financial inclusion. But if we look at the good news, as you heard from the country manager, is that Uganda has made major advances in ensuring that the population can access financial services. By 2014, at least 5 million people, or 44% of the adult population, had access to an account. That's within the financial institution. My country manager was talking about the mobile money that pushes the number even to 7 million. This may be still slow or below countries like Kenya, where this is about 75%, but it's a major progress that has been recorded. And we need to keep pushing on that so that it can help us move in the right direction. On the savings side, this has been slow. About 68% of the adult population engages in savings, but only 16% conduct savings through formal channels. The rest, they keep money under the mattress or in boxes within their stores, in the shops, or anywhere else, but not in a financial system. And 51%, as you realize, keep their money or savings at home, which is very dangerous. Also, when we come to the side of borrowing, we see that Ugandans display a very high caution in terms of getting credit from the financial system. There is a large gap in the proportion of the population holding a deposit account. When you compare how many are holding deposit accounts and how many out of those are actually getting loans out of those deposits, it's very large. 35% of the adults had active loans by the time of the survey that informed this analysis. But actually this was reducing when compared to about 3 years earlier, when this percentage was 44%. So even those that have been using credit have actually reduced, and it's declining. But only 13% of households use formal credit. And within these, only 13% of households use formal credit from the bank. And 65% does not have access to formal credit, with the informal mechanisms increasing from between 2009 and 2013. When it comes to farms, the situation is even more, they say more bad, worse. I'll just pick a few indicators. The percentage of farms with a bank loan. In Uganda, that is about 9.8%. When you look at all countries, that percentage is 36%. Another interesting indicator is the proportion of investments that are funded by banks. We know banks are the source of funding for farms, but in Uganda, only 3.3% of these farms are actually getting funding from banks. Where they are getting the rest of the funding, you will tell us in the discussion. In summary, we find about 5 key issues that have constrained the ability of the financial system to effectively work for Uganda, in Uganda or by Uganda. 1, high cost of credit, high cost in general of financial services, but most of the time we run down to the high cost of credit. The undeveloped state of long-term savings products such as insurance, pensions. When you look at the percentage of contribution of these very important instruments to total financial savings in Uganda, you really wonder where we're going. Third, the low level of public confidence in financial systems. Even where they exist, very few use them, as you've heard in the statistics mentioned. The undeveloped nature of credit and collateral, and the limited outreach of financial services. So moving very quickly to what can be done, we summarize this in about 3 strands. As you heard in the country manager's comments, the issue of addressing the financial sector and making it a better instrument of growth for Uganda and shared prosperity for Uganda requires a multifaceted approach. It is a huge puzzle. You have so many institutions in place, but you also have so many problems. We just summarize it to say, let's mobilize savings, let's make credit more affordable, and let's promote good governance. Thank you for listening to me.
Surely we can do better. A round of applause for Rachel. A quick look in the room gives me the feedback that her presentation has literally opened the eyes and set us up for what would probably be a very, very good discussion. But a discussion around optimism and looking forward to how we can actually do much better. But we will take a very, very short break from both our TV, radio, and online audience. And when we return, we'll come with a hard talk discussion on the growth and development challenge. And the industry captains before us will be addressing the question, can Uganda solve the finance puzzle to achieve faster growth and prosperity? That coming up in a moment. Do stay with us.
You're in the mix with DJ Brian. DJ Brian. Stand up. Brian. Stand up. Brian. Stand up. Brian. Stand up. When I move, you move. When I move, you move. When I move, you move. Hell yeah. Hey, DJ, bring that back. When I move, you move. Just like that. When I move, you move. Just like that. When I move, you move. Just like that. Hell yeah. Hey, DJ. It's fun. It's hype. It's the DJ Brian Mix Show. Bringing the party to your living room.
Isa yalagula Yesu ngali je mabega akali mu bufunzi
Yesu ne Isa ani asookawo munne
Isa
buli lwotayogera na muntu kutegeera bimukwata kutosobola kumutegeera yenna tekisoboka
Ndobuka era edako yakatugamba ti Abaganda mbwanja alaje kasukire gumba gyegenda kala kagamba akukano
obote wateekwa okubaawo eddoboozi abantu lye bakozesa eddoboozi abantu lye bakozesa okutuusa okunnyonnyola kwabwe okutegeerekeka okutangaza bye bakwatako British Empire. Naye nga waka mubimuyita waka mwamuyitanga mutya Big Daddy kuwuliriza kufumiitiriza kukola kwogera bina
Tuwaye.
bwe yamala okutuula ngenda okutunula mu kibatu kyange kino kyentaddeko bwende nga muvaamu ebiwuka ng'ensolosozi.
ebimu byewuunyisa binakuwaza ebirala bikyusa obulamu.
Omuntu atasomye atya n'okuyingira ofiisi naye ng'omanyi nti nina omukyala n'abaana awaka nakinkola nina ne bizinesi naye ntya n'okuyingira ofiisi eno okwennyonnyolako.
Yeddoboozi lye njogerako Tuwaye.
You can now become an exclusive MTV reporter on the go. With the NTV Go mobile app, you can create news by capturing and sharing content instantly. Simply download the NTV Go app on Google Play Store. Go to the N Reporter feature and start reporting as the news happens. We will air your story on a special TV program. NTV Go also allows you to watch news, instant live updates, and follow your favorite show from the comfort of your home, taxi, or your favorite kafunda. Download NTV Go app now from Play Store.
We want to thank you so much for joining us. We also want to welcome our online viewers who are watching and streaming live this simultaneous broadcast as we launch the 8th Uganda Economic Update. I wanted to just remind our viewers, for those of you who have just joined us, that amongst us are key industry players who will be sharing with us their views on this report. But also with us is our special guest and our guest of honor, who is the governor of the Bank of Uganda, Tumusiime Mutebere. We want to thank you so much for joining us this morning. Ladies and gentlemen, we move now to a hard talk discussion on the growth and development challenge. Can Uganda solve the finance puzzle to achieve faster growth and prosperity? Our hashtag this morning is UgandaEU. UgandaEU. We will pick a couple of questions and comments from there to shape this discussion. So if you're online and you're watching or you're here and you want to join the discussion, use our hashtag UgandaEU. We will be able to pick up those questions and comments. I'll probably begin with you, Moses Bekabe, from the Ministry of Finance. Well, I don't know how to summarize Rachel's presentation. There's clearly some wonderful insights into how far we are going and how we are doing. But generally, she tells us that the last 2 quarters of 2016, of this financial year 2016-2017, were clearly, or if I could use other words, we had what would be negative growth. And that in itself shapes the discussion of this morning on how we could leap forward and go back to the positives. I think the Bank of Uganda last year leading into this year did project, close to 5% growth for the 2016-2017 financial year. Is the Ministry of Finance comfortable with these numbers? I'm hoping you'd say no, but you might share insights into where we go from here.
Thank you very much. Let me thank the World Bank for the wonderful work that we do share and the research that goes into informing our development process. Certainly, we take these research findings very seriously and work together to try and see how we can utilize this knowledge, the research, to inform policy, to inform implementation. Yes, the question you asked, I will say we are not comfortable with the 4.5% or 5% growth. But I must say that we're getting out of, we've bottomed out, let me say. And the economy is on the way out to faster growth. Next year, we project 5.5 growth. The following year, growth could leap into 6%. And if some of the investments that we are doing, Karuma, Isimba, the express highways that we're building. We're going to start Jinja, Kampala express highways and all those kind of things. The development of the oil sector has picked speed. Government is prioritizing the oil roads right now in next financial year to make sure that the investments are in place for the oil sector to start producing oil. We see growth leaping forward to 6-7% over the medium term. Of course, there are challenges. One of the challenges, as you mentioned, is high cost of capital. In order to support the private sector, government has made a policy decision to reduce the level of domestic borrowing in order to help reduce interest rates so that the private sector can come out of the burden of private sector debt, which is currently a burden to even the growth of credit that Rachel has shown us on the screen. The second thing that we are dealing with in terms of helping the private sector is this issue that we've been talking about, helping our local producers supply materials and labor and on these major projects, infrastructure projects, what we're calling local content. So that the steel manufacturers, the ones people supplying some of these things can actually benefit from this. But the other thing that government is doing in terms of improving the private sector is really to speed up implementation of public investments. We know absorption has been a problem. We appreciate that. We've been working with our colleagues, the World Bank, including the IMF as well, African Development Bank, to address some of the constraints that have affected absorption of public funds, especially borrowed funds, in order to speed up implementation of public investments. So the other risk that we face in this whole arena is the domestic revenue mobilization, which is still low compared to our peers in the region, which is about 13% of GDP. The Ministry of Finance is prioritizing this, and in fact has set up a working group, including the donors, community, and all those kind of things, to see how we can actually improve domestic revenue mobilization. Because if we don't do this, government won't be able to sustain most of these investments without a high burden of public debt. Because public debt, especially domestic borrowing, I think we're almost reaching a limit on that, and there's a policy of, as I mentioned, of not improving domestic borrowing. But what we are trying to do is to leverage donor financing, especially concessional and not too expensive public debt in order to finance investments. So the other thing that
very quickly, yes.
The other thing that we need to complete, to work together with the financial sector players, the governor here, and including the higher levels of government, is really to complete financial sector reforms. This has been ongoing. There are a number of laws that have been passed in recent last year and also in recent months that support private sector growth in terms of unlocking the financing and also improving, inclusion in terms of mobile money, in terms of bank assurance, in terms of Islamic banking. All those things are being rolled out. Of course, the effects are not yet in. Once that becomes effective, we see the situation improving much greatly. Let me also say that the development path cannot be a straight line in terms of growth, because I think when you talk about negative growth in the first quarter, usually this has been the case in many of the previous years. But it picks up as things improve. What we are trying to do in order to improve also public confidence is to improve governance in terms of public finance management. In fact, the law that we have in place that was enacted in 2015, the Public Finance Management Act provides the key foundation for improving public finance management. And once this improves, I think so that funds can reach targets in terms of roads, in terms of health, in terms of education, in terms of agriculture. In fact, agriculture is the key element that we need to be focusing on more as we focus on, for the financial sector, because I think we need to provide a framework for financing agricultural productivity. That's an area that we need to work together in order to improve productivity. And once we do that, I think even poverty will reduce further. Small businesses will set up, especially if you combine that with infrastructure in terms of what is being done in terms of electricity, roads, feeder roads. That will spur agro-based industries, small-scale, medium-scale industries, which are going to help propel this economy further.
Thank you, Moses. There would have been a follow-up question, but this would have clearly turned out into a monologue. So I'll move to Constance Kachihembo, the CEO of Uganda Women Entrepreneurs Association. And my discussion will be around the financial sector with you. Very quickly, we've seen horrible, I probably, I'm trying to be mean, looking at the report. But it's an unfortunate situation where you have, farms, just 9.8% of our local farms have, do take up loans with our financial institutions. But also we know what happened in the last quarter to our financial sector. But based on that, have the banks played their role? And I know with hindsight, about the interest rates, and we could talk about this until the cows come home. But have the banks played their role in driving this prosperity agenda, national prosperity agenda? And you could actually bring it in with the view of women.
Well, thank you so much, and I must appreciate the World Bank. The report is very informative. It is going to help most of the stakeholders really to...
Just drag the microphone closer to yourself so that, yes, we can hear you.
That's
yes.
Okay. I just said thank you very much for the report. It's very good, and Rachel, that was very interesting report that you have just shared with us. Just from what you've shared with us, in terms of the bank system and all that, we know there's still a big challenge. It has come out clearly, it has been highlighted, the issue of accessing credit. And specifically, I'm going to speak on behalf of the women. Now, the women are the majority, as you know, trying to contribute towards the economy of this country. And when you look at how many women are actually accessing credit to be able to finance their businesses, there are very few. They are still trying to struggle to enjoy whatever is there. Much as the system seems to be better, there are more banks now and more facilities that we appreciate. We heard about the ATMs and all that, the mobile money. They're all good, and they're there to help the women be able to access the funds. But the biggest challenge I think I want to tackle now is the issue of the knowledge gap. In Rachel's presentation, she talked about 68% of the adults who are still keeping their money in the house or in a pot, some sort of a pot somewhere. And then that majority might be actually part of the bigger percentage might be the women. Because ideally, there's that knowledge gap, there's the fear that when they put the money in the bank, there's a lot of high interest charged on their money. This is very hard-earned money from the women perspective. And when you look at what they contribute, the majority of these women are actually in agribusiness. They're in agriculture, they're doing their maize, they're planting their maize, their beans. And when you look at the areas that she highlighted that have been affected, again, like the Sudan crisis and credit crunch and all that, it's the woman who is actually highly affected in a way that the majority of the women have been exporting to Sudan. So they're back. The drought, she talked about, the report highlights the issue of the drought, which has also highly affected the women. So the system, the financial system, well, it's good, it's there, but they're the majority of the people that are actually not benefiting. When you talk about issues of financial inclusion, this is an area that we need to tackle seriously, and that hasn't worked very well because of the fear and of the knowledge gap among the women, and they're the majority that contribute towards the economy. You see, we are not being able to achieve the target unless our investment is actually investing in the area of the people that actually contribute highly to this economy. And that percentage is the women. Uganda Women's Entrepreneurship Association has a strategy of ensuring that each woman can get the information, which the bank should be giving and is actually not doing. We partner a lot with a number of banks, but we think there's a lot more we can do together, together with the banking system, together with the financial institutions, the insurance companies, the ministries, to say that these women can reach a level that they can contribute favorably towards growth. And unless that is done, we will remain into a puzzle. It's going to be a very slow step to get where we want to reach by 2022. And then, of course, the other dilemma that we have is the issue of credit. Many of them can't access credit because either their spouses are the ones who are eligible, if you talk about the collateral, to get the credit. And again, we have a challenge there. However, UWIL has tried to enable them to form cooperatives so that when they're together and they're the many, they can collectively engage into accessing of credit, and they can produce slightly more volume of their products and put in some bit of standard, and we enable them to see that they can export. We are trying to focus on ensuring that our women can begin to export. And definitely for them to start exporting, they will need access to loans, access to credit. They'll definitely need a lot of kind of support to enable them get to that level. So when she was sharing her reports, I could see that it's a total puzzle. We can't talk about economic growth when the women are still at the lowest of the ladder. We must tackle the issue. We must look at what we need to do and invest highly in a woman, and especially the areas where they are participating, which is agribusiness. A number of them are actually getting into manufacturing, but again, they still have the confidence. She talked about the issue of people having the confidence in terms of the financial system. Again, that affects a woman. They take a lot of time to take a decision. They're not like men who have to, they do take risks very easily. So we need to work collectively. I must say I'm happy that the Ministry of Finance has also been coming in, the World Bank, to see that the women are part of the group that can access the funds to enable them grow their businesses.
Thanks very much. I want to come to the insurance, because we have the insurance chief here, we have the securities chief here, we have the Capital Markets Authority chief here. But if I could have a quick microphone, I thought, Fred, I want to bring you in here just before I move to the chief. So if I could have a microphone for Fred Mumza here, who's an economist but also a lecturer at Makerere University. Fred, my question is just picking up from where she's ended. The cost or major constraint to the financial sector, as she was mentioning, with access to finance for women. Where is the challenge? Because you have high interest rates, that's all right. But from her report, we've actually discovered we have a relatively higher banked population right now. With, if I could, include mobile money in there and add the SACCOs and cooperatives that have been put together, we still have a challenge for women to access finance, which in essence doesn't turn out to productivity or reduces productivity in the country.
Well, I'm a man, so I'll say it's not just for women. It's for men as well.
You take risks, she says. It's easy for you to take risks.
And that, I think, is actually the problem, that the risks in this economy are too high. I've talked with people who bring in money from abroad, because we know money abroad is less than 1%. But by the time you put hedging, which is basically to accommodate for the risk of when I decide to take this money back in Uganda, the risks of doing business, because a lot of business finance is supposed to be sales revenue. You literally borrowed from a bank to beef up your revenue. You must get sales. You must be able to sell to whatever you have produced, raise what you can pay back to the bank, but also retain something for your business. You cannot grow your business literally by borrowing from the banks only. Now, in an economy where there is very low demand, aggregate demand, every business is going to have a risk. And then the banks will also recognize the ability of you to be able to pay back is very low. So there is deficiency in aggregate demand, and we need to get back to say short term. I know infrastructure is good for growth, But aggregate demand and investment, private sector investment, is even more critical for immediate growth, because infrastructure can only give you growth over the long term. Now, how do you get to the long term without the short term? Now, those are the things that are really affecting the economy, that you cannot jump the immediate river, but you're already planning. When I grow up, I will be a doctor. First finish your primary exams. You're not dealing with that. So I think it goes back to what is the major macroeconomic government policy. And Governor just next here, I was reading some of his write-ups. What did we do right in the 90s? We brought down inflation purely by managing fiscal policy. Bring down government cost. Bring down this appetite of government to invest in now what has become dead infrastructure. Because that infrastructure is not giving you the immediate returns, and yet it has gobbled up all your money. So this economy has completely no money. There is no way you're going to bring interest rates down in an economy without money. The government has borrowed in trillions. The government is now budgeting to pay back interest payments in trillions at the expense of basic medical services, agricultural production, basic health services. So you don't have short-term revival. This economy badly needs a short-term stimulus to get back before you can even think of the medium and the long-term growth that you'll pick up from your investments in infrastructure. So it has to go back to government strategy, rethinking their borrowing. I was looking at the borrowing of, I think, 2 years, a fiscal bond is 16%. What do you expect a bank to lend to a woman's business down in Owino, down in Kaberamaido? At what rate? And what are they selling to be able to recover that? So it's a macroeconomic problem issue, and you're not going to throw it to the banks.
All right, Fred, I'll hold your thought there. Well, let me turn to Paul. Paul Bwiso is with the Uganda Securities Exchange. Paul, you're a key player in this industry, and speaking about stimulus, you're among the people that should be stimulating this economy. But unlike the other region or players or countries in the region like Kenya, we literally have, if I could use some harsh words for you, a very flat securities exchange, dull securities exchange. There's limited activity in the last few weeks on the exchange, and that literally explains the state of the economy. Do you agree?
Yes, I do. Well,
that's the shortest answer this morning.
Thank you for the invitation to make a few remarks at this press briefing. As far as when you look at the stock market, the securities market, it is a benchmark for the way the economy performs. We do see a lot of foreign direct investment into the different stocks on this market. However, with challenges at macro levels, especially during 2016, we did see a reduction in the investment on the stock market. If we go back as 2-3 years ago, we had over 466 billion trading in the stock market. This reduced last year to about 167 billion only. That is the impact of the foreigners participating in the market. But also to speak, the stock market provides an avenue to raise capital, both medium-term, long-term, for different businesses. And it's not been an area that both the government and the private sector have utilized to raise capital. One of the challenges, if you look at the economy, government raises money through taxes. But who pays the taxes? It's the private sector. So the private sector needs to actually needs to grow and be facilitated to be able to increase productivity and be able to pay taxes for government to actually carry out its programs. The market, if government bonds, 5-year, 10-year, 15 years, are trading at interest rates of 16%, how do you expect the corporate bond market and at the stock exchange to actually be able to lend money to the private sector? So we've been actually crowded out as a market and been unable to play our role. In terms of businesses, we've also found a big challenge that most businesses in Uganda don't have the corporate governance that is required. They do not go that extra mile to look at, well, my business be 15 years. It's not about business today, 2 years, 3 years. It's about 5, 7, 10 years. Most private equity funds have come into the country, have picked up businesses and have grown them and have sold them off after 5-7 years. Look at Actis in Umeme, and has left a big story of a company that can actually be run by Ugandans, employed and added back to society. So in terms of the economy and what we give back as capital markets, we have long-term investment through pension funds. And one shouldn't look at the pension funds as just Ugandans. We have East Africa, we've got Africa. Most of our investors come from the South African market and England, Europe. And they participate in different businesses here. So we might not have mobilized savings locally, but we can gradually work on that systematically with the help of the government and our regulator, the Capital Markets Authority, to be able to raise this money that can be input in the different products. Finally, there's the key part on matching capital, the right kind of capital to finance. Long-term capital, if a company is needs a manufacturing plant and needs a return on investment after 15 years, it's important to match the kind of capital you raise to that kind of investment. But if you're borrowing from a commercial bank at 25%, when will you get a return? We've heard about the sales, because it's about the sales generating the business on a day-to-day basis to be able to finance your business. So managing one's capital is very important.
Thanks, Paul. Keith Kariejira, who's the CEO, Capital Markets Authority, as a regulator, and Paul mentions, there's low public confidence in the financial sector, and it's picked up from, low investment in the securities exchange, low uptake of financial securities. Where should we be looking? How do we then build this public confidence to increase our uptake in our, facilities that are available, bank facilities that are available, but also other investment opportunities in the domestic market that would actually spark productivity?
Thank you, Maurice. Thank you, World Bank, for this very informative report. It was very difficult to find anything to criticize in the report, perhaps apart from the fact that the role of the financial sector might be being overplayed as far as growth is concerned. The private sector looks for where to invest. If a country is growing fast, money will flow from every direction. And the whole beauty of the capital markets is to tap into both domestic and international savings, which we need to grow as a country. I think there's a lot of reform discussions going on about our pension reform. Our pensions have been growing at about 30% every year over the past 5 years. And this growth is expected to be sustained, but we need more products in the markets. Now, the issue goes back to confidence. Confidence runs through is a string that runs through every part of this discussion. And we talk about governance. The companies that ought to be coming to the capital markets to raise funding need to put their house in order. Many times they're a little bit shy to come forward because there's so much scrutiny that they have to go through before they're admitted to become public companies. They end up going to banks to finance, as Paul was saying, long-term projects with short-term finance. That's a very serious mismatch. Inevitably, they'll struggle to grow fast enough. So there's a lot more money in the world looking for investments than the good investments. All people need to do, all companies need to do, all businesses need to do is to fix their governance structures. I think it's a low price to pay to have access to all this money. And I call it patient capital, because many times, it's, as Dr. Mumza was saying, you cannot tell whether your revenues are going to catch up with your planned expansion capacity in time. So you need patient capital to be able to weather the storms and go through all this. So really the buzzword here is confidence and the importance of governance. I can't overemphasize the two.
Thank you, Keith. Kaduna Bilubega, finally, as a member of our panel, one of the biggest risks to our macroeconomic management is insurance. And when listening to Rachel make a presentation, we could have actually had a buffer on some of the challenges we have. Most recently, we have an agriculture insurance. We could have had, insured our businesses in South Sudan, or some of our, businesses. Of course, a lot of them were very informal. That, for us, is one of the biggest challenges, the fact that a lot of our firms and organizations have not seen the need for insurance.
Thank you very much. And I would like also to add my voice to thank the World Bank for the report. Unfortunately, you realize how uninformed many of our people are, because even what has been highlighted in the report as the challenges we face, many of them are insurable, really. And I do want to say that we need to, maybe as insurance players, but even other entities, development partners inclusive, need to address how they can partner with the insurance regulator and insurance players to inform the public on what can be done. Because insurance is there as to take on the risk. So if, like we have now the agriculture insurance in place, we have the micro insurance, which can insure the small businesses and the fires which we have had in the markets. You realize many of the insurance companies have come in handy to make good those who lost. We also, when we were looking at the challenges of why people do not borrow money, they are talking of collaterals, but they must also be aware that they can take on insurance, credit insurance, and they don't need to go into having collaterals in order to access maybe a credit facility. Many of these things need to be done, but I must say that we need to do a lot of literacy campaign to educate the masses on what they need to do in order to address many of the challenges. But when we also put on the market products like agriculture insurance, they need to be helped. I'm happy that government of Uganda came in with a subsidy for this financial year running. But maybe it needs to be improved. It needs to be improved on, and we move forward. So I really also know that there are historical factors which hinge on why the insurance uptake is still low in Uganda. Some of them, like the hyperinflation which we were talking of in the 70s, and the currency reform which removed the zeros, and people thought that they lost the value of their life products. Some of them have been there and they are historical in nature, but we must move on. All Ugandans must know that we must move on, and insurance companies in Uganda are in place to address the challenges which we are facing. As Insurance Regulatory Authority, we have continued to address the challenges as we identify them, and that's why, as we speak now, our law is before Parliament. It is going to be overhauled to look at the risk-based compliance, underwriting, and risk-based supervision, which is the modern way of looking at risks.
Thank you. Thank you very much. Ladies and gentlemen, if you've just joined us, we are at the launch of the 8th edition of the World Bank's Uganda Economic Update, and we are taking a very, very, very short break. But just to set the discussion in motion on where the plenary session will be focusing, there is a lot of uncertainties in the global economy, and also we will have an election in the region, or probably elections in the region, Kenya, which is of course one of our biggest routes for our imports and exports. How that will play out will make part of the discussion when we come back. And that discussion continues on NTV and KFM, but also for you, viewers online. Do stay with us.
You're in the mix with DJ Brian. DJ Brian. Stand up! Brian. Stand up! Brian. Stand up! Brian. like that. Just like that. Just like that. Hell yeah. Mama drop, Daniel. It's fun. It's hype. It's the DJ Brian Mix Show. Bringing the party to your living room.
You can now become an exclusive MTV reporter on the go. With the NTV Go mobile app, you can create news by capturing and sharing content instantly. Simply download the NTV Go app on Google Play Store. Go to the N Reporter feature and start reporting as the news happens. We will air your story on a special TV program. NTV Go also allows you to watch news, instant live updates, and follow your favorite show from the comfort of your home, taxi, or your favorite kafunda. Download NTV Go app now from Play Store.
From the land of the rising sun, 100 determined athletes have accepted the challenge to become
I will be. I'm gonna be the first
Ninja Warrior. Divided into 4 extreme stages, competitors face the ultimate test of strength and will in their quest to become champion. Many are called, few are chosen.
Demonstrating incredible speed, strength, and focus, Levi demolished the second stage. Makoto Nagano achieved the near impossible by becoming only the second man in history to complete all 4 stages of Ninja Warrior.
Now, let's find out who's tough enough to become the next Ninja Warrior.
Edition of the World Bank's Uganda Economic Update. Step by step, let's solve the financial puzzle, or the finance puzzle, to accelerate growth and shared prosperity. We're coming to you live from the Kampala Serena Hotel. This is a simultaneous broadcast on KFM and NTV Uganda, and also online for our viewers who are streaming. Our hashtag this morning, Uganda EU. Do get that trending, but also share with us your comments and questions on what we are discussing. We're moving quickly into our plenary discussion, and we will continue to answer the question on how Uganda can solve the finance puzzle to achieve faster growth and, of course, prosperity. I want to introduce Gideon Badagawa. Gideon could be given the mic. Gideon Badagawa is the Executive Director, Private Sector Foundation. And my question to you, Gideon, I'm hoping Ben, where's this microphone? My question to you, Gideon, is the role of the private sector in driving this conversation around growth and prosperity amidst the storm that Rachel shared with us.
Thank you very much, Maurice, and I want to appreciate the bank for the presentation, and I hope we can pick lessons and policies to implement, and when we come for the 9th one, we should be able to measure progress. Yes, and the predicament, the private sector, the lending financial institutions are private sector, and the borrowing public are private sector. So I find myself in a terribly precarious situation. But you ask the question, are banks playing their role? And I want to say, yes, they are playing their role, because what's their role? Their role is to make money. And until we begin to shift the role of the banks from purely being a commercial role to a development role, and I think this is where regulation, again, could help us, it might be difficult for us to reduce the NPS.
But Gideon, let's...
And the reason we have the high cost of borrowing, Maurice.
In our local language, Gideon would have said Simba Wakati. But let me ask, why would I be in a market, where I'm doing business? If I'm to make money, and as my goal, to make money through business, lending money at high interest rates to, recover my money immediately or quickly. Why would I continue that path if there's no one coming to take up my money? Or if everyone I've actually lent money, I spend a little more money to recover my money. Why this doesn't make financial sense? So there must be a middle line, and that's where I thought the private sector would even out the discussion. Yes,
Maurice, for as long as the banks are not going to help the borrower understand their obligations, it will be difficult for banks to remain afloat. And we have just seen one go under. The governor is here.
He will not say it is going to float. It's been organized.
Yeah, but as long as you don't relate to the clientele, the people that are picking money from you and helping them on loan performance, following up on this credit, and I think this is where again the central bank could help us on getting the commercial banks understand the development role that they have to work with the small borrowers especially to understand this. Otherwise, we keep posting non-performing assets. That's one. Two, we thought earlier on that because of the competition, the interest rates will go down. They never went down because of the imperfections in the market. Because all of us know that the assets, the bank assets in this country, up to about 40% are owned by about 3 banks or 4. And again, the governor is here, will clarify this. But that is a lot of imperfection in the market. And it also leads to the high interest rates in the market. So as long as that imperfection is not addressed, it might be difficult again to see lending rates go down. Then 3, I think it's quite a challenge, and I think it's a mistake for us to assume, and I think Fred has made that remark, for us to assume that the economic challenge in this country will be addressed from the monetary side. No, it must be addressed by fixing the structural rigidities from the fiscal side. I think this is where the mistake has been in the last 3 to 4 years, and that's why we keep seeing very low rates as opposed to 15 years, 20 years ago. 4.55% growth rates are coming because of the indiscipline in spending in government. Why is government in the market? And someone mentioned we need to cap the public sector borrowing requirement. So the question should not be capping interest rates, and I think the governor will be happy to hear that. I think the challenge is more on the fiscal discipline. Can we put money, when we go to the market and borrow money, where are we putting money? Are we putting this money in areas, in sectors that create wealth, that drive growth in this country? And it cannot only be infrastructure, it must be business development as well. So do we see government increasing the borrowing to support the private sector in terms of business development? Or do we see money being sunk into non-wage and infrastructure? Because this does not drive growth in the short term.
Thank you very much, Gideon. If you could pass on the microphone to Dr. Victoria, who's next to you. Victoria Secretarial, CEO, Uganda Agribusiness Alliance. We'll kick off from the agribusiness side. You and us and I and several others share a passion for driving productivity in agriculture that could actually spur this economy, because literally it employs the majority of Ugandans. But no farmer, I guess, or there's limited number of farmers that have actually taken up an insurance facility for agriculture. One of the biggest shocks the sector had was the drought in the last 2 quarters of the first 2 quarters of this financial year. But last year, what happened to us? You literally are the cushion we need for the economy, but there's limited support to your sector. Is that the biggest challenge, or you believe there's other challenges to your sector?
I think from the way I see it and the way I see it right now, the problems in the agribusiness sector are immense. But with good governance, half those would just disappear in one day. What do I mean? Right now we are talking about drought, we are worried about Kenya elections, we are worried about Sudan. But why should that be our care? I'll talk like a woman. For us women, when there is a crisis, we first find out how we can benefit from that crisis. So how can Uganda benefit from the current famine in the region, the current drought? In my view, given the fact that we own all the water in the region, we should concentrate on the agribusiness sector and produce as much as we can. Don't worry about going to Mombasa. The Kenyans normally come here for their food. The Sudanese will find a way of coming for their food. Right now, we have confirmation, which is very unfortunate, that the whole of Southern Africa did not only suffer from drought, but now they have been attacked by the maize stem borer. When that worm arrives in your country, you harvest nothing. So Uganda has got to feed not only itself, not only the immediate neighbors, but the whole of Southern and Eastern Africa. That is such a bad crisis, but a fantastic opportunity for Uganda. So instead of concentrating on finishing this dam and finishing that road, which is not taking us anywhere, like somebody said, that is what we call dead cost. We have put the money there, it is not going anywhere. Short term. Let us invest where we can get some short-term solutions, which will lead us to long-term solutions. How? Invest in agriculture. 4 out of every woman who works in Uganda is in agribusiness. But how much support are they getting? Practically none. I'll explain why. When I go to the banks and I go to all the funds which are available, every fund says, if you have got a business which is worth more than $300,000, we shall give you money. How many women, including the one speaking, have a business more than $300,000? And if I had that, I wouldn't need you. Going back to taking advantage of crisis, when I heard that there is very little foreign direct investment coming to Uganda, I'm like, whoo, that's good. Who needs them? We have got everything we need in order to invest in Uganda. So can the Uganda government work with the private sector and we invest in ourselves? That way, we shall definitely be on top.
Thanks, Victoria. I thought I would introduce Dr. Abuka Charles, who is representing the Executive Director Supervision, Bank of Uganda. Is Doctor, yes. Fred, I'll indulge you to help. Okay. As you know, who's overseeing our financial stability? The majority of the questions and a lot of the discussion this morning is centered around regulating the financial sector, a lack of public confidence in the sector, but also the high interest rates in the sector, which have made literally borrowing impossible. Looking at the statistics, if local firms cannot even pick local loans, then that is a challenge.
Okay. Thank you very much. I'll be a bit brief because the issues are too big. But I'll pick from what Mr. Kadunabi mentioned. First, to put a historical context to this issue of public confidence. If you want to see a period in which there was very huge drop in public confidence, look at the period from 1971 to 1985. All the metrics about your financial sector in terms of depth, credit to GDP, monetization collapsed because of inflation and insecurity. That's what you call public confidence collapse. It does not characterize the current period. We need to get that right so that we give the correct prescriptions. Now, you're saying, what is the regulator doing? There are a number of things that the regulator is doing as part of what you would call second-generation reforms. And some of those include, first let me talk about, okay, what is the regulator doing in the financial sector? There are a number of things. First, the managerial issues in the financial sector are an important area of concern that the regulator looks at. So that's one of the areas to improve the issue of corporate, which came up. Regulation has also got to deal with building of capital and liquidity buffers. If these buffers are weak, you do not have a resilient financial sector. We need more intrusive supervision. That's what we are doing. If we characterize you as a DSIB, it means we are looking at you much more so that you do not collapse so easily and affect the public. There are a number of other things that we are dealing with. For example, risk analytics. this must improve both at the level of the banks themselves and also at the central banks. How do you see risk going to the future, and how do you build the capacity to deal with those risks? These are very important. Then I got the question of the very high interest rates, and I'm actually touched with the discussion on what kind of finance should women be accessing. There are a number of issues that affect the interest rate environment in Uganda. One of them is actually we have to deal with the issue of the long-term capital. Maybe the women are getting the wrong kind of capital for their problem. So we need to resolve this issue. If our women want access to mortgages, maybe the right kind of financing is that we resolve the issue of accessing financing from the pensions and social security system, so that we get something which actually fits to use to finance mortgages.
And put in place a legal framework that supports that.
That's right.
Yes.
So for the time being, let me just stop there.
Thank you. I wanted to quickly open this up, just in case you have a comment or question. Let's make it very brief. I'll come to Mr. Bosa Bire later. Quickly, if you have a question or comment, please raise your hand, and let's not turn it into a press conference. I'm happy to take the press into another session much later. If you have, okay, yes, there's a gentleman there. Keep it short. Please introduce yourself for purposes of radio. We need to know who you are.
Yes, Sande Protazio, Insurance Regulatory Authority of Uganda.
Quickly, yes.
The discussion seemed to be concentrating on growth, low growth. But my problem would be on where this growth is coming from, because 4% could be good enough if it can be sustained. So as we discuss, we need to see where is this growth coming from. Can we sustain it in the short term and in the medium term? And that's how insurance comes into the picture, sustainable risk management.
Thank you very much. Moses, I think I'll direct that question to you very shortly. I'll take one more just before I introduce. All right, please bring the microphone here to Mr. Bosa. Mr. Bosa is chairman of the Katwe Small Scale Industries Development Association. Yes, you're a key user in this discussion.
Thank you, Mr. Moderator. First of all, I would like to thank the World Bank for organizing this important event. And I'm the chairman of Katwe Small Scale Industry Development Association, and I'm also the chairman of the National Informal Sector Organization, Uganda chapter, which is affiliated to the East Africa Confederation of Informal Sector Organization. When it comes to this discussion, you are all aware that the informal or the so-called workers takes 80% of the employment of the Ugandans. And when I had my colleague from WIL talking of women, and 90% of these women are part of my sector, the informal, we have a problem with the banks. First of all, just some 2 weeks ago, we went to the bank, we wanted some credit. Someone from the bank, in a certain bank, told us, oh, you people, the informal, your risks are high. So, which means the interest rates also should be high. And he was talking of, for those who are already developed, the bigger companies, they get at least a credit. The credit is the interest rate is low than those of the small ones or the micro one because of the risks involved. And these are the people who don't have the collaterals. You can hardly get someone from Katwe who will go to the bank and borrow. And you find that these are the people who need the bank. And when someone says that 68% of the people, or of the entrepreneurs are not, they shy away from the bank, it is true because of some of these issues. You find that 80% of Ugandans, these people, the entrepreneurs, are the majority who are in the formal sector, And then these are the people who are being charged high in form of interest rates. How do you expect really the sector to come out? Like Mr. Gideon has said,
yes, very
these
quickly.
people,
very quickly, yes, summarize.
these people, they are in business, and you find that when these people, when the policymakers are trying to plan for the informal, we see some of the implementer and the policymakers are on the different pages. They are really on different pages. And you find in such a circumstance when someone is reading a different page and is planning for another person who is on the different page, I don't think they can really have anything.
Thank you very much. Thank you, Bossa. It's a discussion that could continue until the cows come home. But I want Moses to quickly, in a minute, you should be able to address both. If you can find a way to summarize that in a minute. We've run out of time. Yes.
Yes, we've run out of time. Thank you so much. I think in terms of long-term finance, this is a priority for government. That's why we are pursuing reforms in the pension sector. That's why we're undertaking reforms in broader financial sector, insurance. We have a bill in Parliament right now to address some of these issues. I think what is important is really to complete the reforms in order to unlock institutional finance. So I think that's one of the things that we need to do. In terms of high interest rates, even if government stopped borrowing tomorrow, interest rates are not going to be 10%. They're not going to be 12% because there are other variables that go into the structure of interest rate. For instance, the quality of collateral, the cost of infrastructure, which we are addressing as government, and also personal risk. Those are some of the things that actually inform the high risk care. But what we are trying to do in terms of government is not to escalate interest rates. What we are trying to do is really to lower domestic borrowing in order to address that, and also to push forward reforms in terms of pension and also in the insurance sector. The other, there is the issue of sustainability that the gentleman,
yes.
the 4%. Of course, this can be sustained. What we need to do, and that's what we are trying to do, when you look at what government is trying to do, the government program in terms of policy, is to ensure that there is a modernization of the legal framework to support the business sector. And that's what I'm talking about. The second one is to do with the consistency in terms of policy, in terms of implementation, and also in terms of improving efficiency. And then the last one is really playing by the same rules in terms of making sure that whatever legal framework is in place, whatever regulations are in place, they apply uniformly to everyone. That will help build confidence in government.
Thank you very much, Moses. I want us to wrap up this discussion, and to help me reflect on our discussion this morning, I want to invite Kevin Curry, who's the lead economist of the World Bank, who promised me he would be extremely brief, and then we'll invite the governor to speak to us. Yes, Kevin.
Thank you. So I wanted to keep to the promise of being brief. As I reflect on the discussion today, I think we've heard two words over and over again. One is confidence, and the other word is risk. And they're really flip sides of each other. So, and I think it's useful to bring this notion of risk down to the very concrete level and ask what kind of risks are we talking about. It could be the risk, is the government going to finish these infrastructure projects that we've been talking about? That's a risk. People could be wondering, is their deposit in the bank safe? That's a risk. Is it going to rain to make sure that the crops come in when they're supposed to? Those are risks. And then there are risks that occur abroad, risks in other countries. So people are facing all these kind of risks. One thing we can say about this environment, when you've got risks, when there's a lot of risk out there, people look for liquidity. Liquidity is a way, having cash is a way that people handle this excessive risk that they see. And that means saving cash at home, which is not a very good idea, but people often don't have an alternative. It means putting cash in banks at very low interest rates on deposit, or it means paying a very high interest rate to access liquidity from banks. So what we see in the financial system is there's all this risk that's out there, and people are reacting to that by using an imperfect financial system to help them cope with that risk. So if I was to close with one point, it would be, how can we reduce the level of risk that people are facing? I think we have to divide it up into two parts. We can't do, as economists and business people, we can't do anything about events in Juba or in Europe or in the United States. But we can certainly have ways to manage those risks better, and that's already been talked about in terms of insurance. There's probably more in terms of insurance and deeper capital markets that we could do in terms of managing those external risks. But what we can do is we can stop creating more risks here in Uganda. We should not be adding risk to an already risky environment. And that means, you know, a strong policy environment to reduce some of these policy uncertainties that we've been talking about, making it clearer for everybody what the rules of the game are with policies and with institutions, and certainly not amplifying any shocks that could be coming to the economy through monetary or fiscal policy. And this is something Moses has addressed, and you know, the governor is well aware of this as well. So it's about those risks, those external risks that we can't do anything about. It's about managing those better through all the work that's been done by the excellent colleagues here on the panel. But here in Uganda, it's first of all about not creating more risk, not creating more shocks, and not amplifying shocks that may be out there through mistakes in policies or weak institutions. So going forward, I think that's the agenda that we see. And I like this results orientation of saying when we come back for the 9th, we should have made some progress on reducing these risks and managing them better. So let me stop there. Thank you.
Thank you very much, Kevin. I think I'll request the country director to come and do the honors of inviting our chief guest to speak to us.
Thank you very much, Maurice. Honourable Governor, it's always a privilege to be able to benefit from your reflections and your remarks. Kindly do us the honour to share with us your reflections. Thank you very much, Honourable Governor of the Central Bank.
Ms. Christina Calvo, World Bank Country Manager for Uganda, members of the Diplomatic Corps, distinguished guests, distinguished panelists, staff of the World Bank in Uganda, distinguished guests, ladies and gentlemen. I would like to begin by commending the World Bank for publishing the 8th edition of the Uganda Economic Updates series, which over the last few years, has provided a valuable source of economic analysis for everyone with an interest in the Ugandan economy. I would also like to thank the presenters, discussants, and other contributors for all the important insights that they have given us this morning. Given the main theme of the latest economic update, I would like to take this opportunity to offer my own personal perspective on the development of the financial sector in Uganda, its role in the economy, and the challenges which it faces. To begin with, I think that it is important to recognize the progress which the financial sector, and especially the banking sector, has made over the last decade. Between 2005/6 and 2015/16 fiscal years, commercial bank credit to the private sector expanded by more than threefold in real terms, at an average real rate of growth of 20% per annum. Although bank deposits also grew strongly over this period by 2.5 times in real terms, there was a marked rise in bank intermediation, with the ratio of bank loans to bank deposits rising from 53% at the beginning of this period to 70%, which is a remarkable improvement. Secondly, there has been a notable strengthening of competition in banking markets. The Herfindahl-Hirschman Index of market concentration in the banking market fell from 1508 in June 2006 to 909 in June 2016. Fell from 1508 in June 2006 to 909 in June 2016, denoting a substantial reduction in market concentration and therefore an implicit increase in competition. The fact that competitive pressures have intensified in the banking market over the last 10 years is also reflected in a secular decline in the industries, in the financial sectors after tax returns on equity, from 32% in 2005-6 to 14% in 2015/16. I think it is no longer tenable to argue that banks in Uganda make excessive profits. Thirdly, there have been occasional incidents of bank distress and failures over the last 10 years. But prompt regulatory interventions by the Bank of Uganda have ensured that the interests of depositors have been taken care of. Indeed, the interests of depositors have always been fully protected, as was recently the case with the resolution of Crane Bank. This is, of course, in line with the mandate given to the Bank of Uganda under the Financial Institutions Act which prioritizes the safety of customer deposits. In that regard, therefore, I do not understand why the economic update should have concluded that there are low levels of public confidence in formal financial institutions, which discourage the public from holding bank deposits. This conclusion is not borne out by the rapid growth in both the number of bank accounts and the real value of bank deposits over the last 10 years. Notwithstanding the strides made by the banking industry, I agree it still faces major challenges, particularly the cost of doing business is rather high, but this is partly because the industry has not yet realized optimal economies of scale in its growth. As a result, annual operating costs average approximately 11% of income earning assets, which accounts for a very large share of the interest rate spread. But the spreads will only be reduced when banks can become more efficient and when they reduce their operating costs. I believe that automation and new technologies to deliver financial services will offer avenues for banks to reduce their operating costs over the medium to long term, although this will also expose banks to new forms of operating risks. Banks may also be able to exploit synergies with other financial services, such as insurance, to improve efficiency. The economic update argues that, and I quote, the high cost and limited access to credit has become a binding constraint on Uganda's economy. I'm afraid I cannot believe that. While I do not dispute that bank lending rates are too high and need to be reduced in a sustainable manner over the long term, I do not think that the claim is really tenable. It implies that if only banks and other financial institutions could lower their lending rates and thereby expand the volume of their lending, substantial numbers of businesses in the real sector of the economy would be able to borrow money for investment in order to expand their output and thereby both service their debt and increase their incomes. Unfortunately, the conclusion that access to credit is the binding constraint on economic growth is premised on a rather over-optimistic view of the real sector and its borrowing capabilities. Formal sector creditworthy businesses, which are the main business clients of the commercial banks, comprise of a small share of the Ugandan economy. It's a very important point. Formal sector creditworthy businesses, which are the main business clients of the commercial banks, comprise a very small share of the Ugandan economy. There is a much larger pool of informal businesses and micro enterprises, but the capacity of this sector to utilize credit effectively is constrained by a raft of problems, including scarcities of business and technical skills, high costs of inputs, and often volatile market conditions. The ability of these businesses to make profits consistently and thereby to service their loans is very precarious. The problems are most acute in smallholder agriculture, where qualitative changes in agricultural practices are a prerequisite for farmers being able to utilize credit productively. Above all, land reform is also needed to support the transformation of agriculture in many parts of Uganda. Unfortunately, we have been waiting for this reform for too long, and it's not coming anywhere near. The argument that micro loans alone can transform the fortunes of the household enterprises doesn't hold water. Certainly the evidence, empirical evidence in Uganda and elsewhere in Africa does not support that. In addition, attitudes towards borrowing are poor throughout society. Loans meant to fund business expenses are sometimes diverted for personal expenses or speculative purposes, and the culture of loan repayment is extremely weak. Until a much stronger private business sector can develop in Uganda, characterized by good, modern business management and a clear separation of business and personal interests on the part of business owners, it will be very difficult for banks and other financial institutions to further raise the level of financial intermediation in Uganda. To conclude, I believe that it is really necessary to be realistic about what can be expected from the financial sector. The shallowness of the financial system in Uganda reflects the structure of our economy much more than the deficiencies of the financial sector itself or of the institutional and regulatory environment in which the financial sector operates. In many respects, technology, productivity, levels of professionalism, and the application of modern business practices. In these respects, the financial sector is one of the most advanced sectors of our economy. You don't think so? In many respects, technology, productivity, levels of professionalism, and the application of modern business practices, the financial sector is one of the most advanced sectors of our economy. That's what I believe. Most of the other sectors of the economy are not as advanced as the financial sector, and some, indeed, lag far behind the financial sector. It is the structural problems afflicting the real sectors of the economy which provide the largest obstacle to greater use of financial services and especially credit in Uganda. I thank you for listening to me, and I apologize for taking so long. Thank you very much. Finished. Thank you very much, ladies and gentlemen. Despite my comments, this has been a fantastic event. Thank you very much.
Another round of applause, ladies and gentlemen, for the governor, who's always very candid in his discussions on matters before him, and of course, this morning, the release of the 8th Economic Update on Uganda. Ladies and gentlemen, we must release our TV and radio audiences, but if permission is granted, we will gladly continue this conversation informally. I think we still have some time. But we want to appreciate those of you who joined us on NTV and KFM for this discussion this morning. The subject and matter before us on how we can solve the financial puzzle to achieve faster growth and prosperity continues online with our hashtag UgandaEU. We have a team of staff from the World Bank who may be able to get back to you on a couple of questions you may raise on that hashtag. So we will continue to follow that discussion online. We want to thank you for joining us, and stay tuned for normal programming.
NTV, turning on your world.
You can now become an exclusive MTV reporter on the go. With the NTV Go mobile app, you can create news by capturing and sharing content instantly. Simply download the NTV Go app on Google Play Store. Go to the N Reporter feature and start reporting as the news happens. We will air your story on a special TV program. NTV Go also allows you to watch news, instant live updates, and follow your favorite show from the company.